Nice to see everyone. I'm Justin Hutchens, and I am a co-moderator of this session with Bree, who will introduce herself shortly. It's great to be here, and thank you to NIC for bringing us all together. Before we begin our panel discussion, I have a few brief reminders. Today's session is being video recorded, so please take a moment to silence your devices. If you have questions, submit them through the mobile app. If we run out of time before we address your question, we will work with Nick to ensure someone follows up with you shortly after the conference. And finally, please take a moment to complete a brief survey at the end of today's session. Nick welcomes your feedback. It's nice to be with you today. I'm Justin Hutchens. As I said, I'm the EVP of Senior Housing for Ventas. My background is 25 plus years in senior housing. I've been in real estate investment. I've been on the operating side, running large operating companies. I've basically been back and forth twice. And I've done it here in the US, and I've also worked in the UK. And I'm a NIC board member. And I'm gonna ask our panelists to introduce themselves, and then we'll get started.
Hi, I'm Nicole Sermier. I'm a partner with Sculptor Real Estate. I oversee our residential investments, generally including senior housing. And Sculptor Real Estate, we manage about $5 billion in equity in closed and discretionary funds. So traditional opportunistic equity investing as well as credit investing.
Hi everyone, my name is Lana Peck. I'm a senior principal with NIC. My subject matter expertise tends to be in the seniors housing side of the business. And I've been with the company for about 5 years, and I have over 20 years experience specifically in the seniors housing and care industry. And I also have a lot of experience with regard to market feasibility assessments and consumer market research as well.
Good afternoon, everyone. I appreciate everybody skipping lunch to come listen to this tremendous panelists of us up here talking about different ideas. I am Chris Byrd. I'm the Executive Vice President, Chief Operating Officer at LCS. Similar to Justin, I've been in the field for over 25 years. I've gone from sales and marketing over to operations, back and forth, and I've been enjoying my last 4 years with LCS.
Good afternoon, everybody. My name is Bree Grubbs. I'm the EVP of Revenue for Leisure Care. Leisure Care is a nationwide operator of 50 communities, predominantly independent and assisted living with some memory care as well. We have a hospitality emphasis in everything that we do. I've been there for 16 years, started out on the sales side, worked on the development, new business market research side for a number of years, and have come full circle. I oversee sales, marketing, and our new business team now, and look forward to spending some time with you this afternoon.
Great. Well, let's get talking about this exciting opportunity to recover in the senior housing sector. And we're going to start with Lana, who's going to give a market overview.
Thanks, Justin. Are we seeing it now? Mm-hmm. Okay, I'm going to start out our panel discussion today. I'm sorry about that. Can't see the confidence monitor. I'm going to start out the discussion today talking a little bit about the nuts and bolts of the recovery. And I'll be using some NIC map data to illustrate where we are in the recovery and where we are in terms of overall demand. We'll also take a look at some timelines for recovery and some calculations that you can use when you go back to your own properties before we get into the discussion. So there are three kind of nuts and bolts ingredients for occupancy recovery. The first one is recovery of vacant units due to the pandemic. The second one is uptake of units that were in lease-up before and during the pandemic. And the third one is occupancy of new units coming online now and in the future. So the first ingredient is reoccupancy of units lost during the pandemic. And what we see from this chart is that the number of occupied units in the primary market, the NIC map vision tracks, you see these in this chart here. If you look in the insert, by the first quarter of 2021, the number of occupied units had fallen pretty considerably. That dip in occupied units actually equaled about 42,000 units. So that's 42,000 units less than the peak that was achieved in the first quarter of 2021, just prior to the pandemic. and it's back to 2017 levels. Now, there are some things that could make the recovery go faster or slower, and I'm going to cover some of the things that might make it go faster right now. So if we take a look back on historical absorption levels, comparing those to the third quarter of 2021, absorption, basically some pent-up demand from prospective residents that was waiting on the sidelines, was really kind of swept up in that third quarter, swept into our properties. So the key question will be, will that pent-up demand has it been spent in the third quarter, or will it continue to reach record paces going forward? Demographics. It's undeniable that the demographic wave is on our doorstep. Just even in this next 10 years, actually by 2027, we're going to have an additional million people 80 plus in our population. And I think it's undeniable that that's going to tell us that we're going to really need to have congregate care settings, both in higher acuity and lower acuity settings that are lifestyle oriented as well. It's also important to consider the caregiver ratio here, another indicator of demand. When we think about the number of persons that are of the age to care for people age 80 plus, those that typically are in the age 45 to 64 range, that ratio is going to fall significantly over the next 15 years. And currently, that ratio is 6 to 1. By the end of the decade, it'll be 4 to 1, and in 15 years, it'll be 3 to 1. So another really compelling reason for the need for congregate care settings. And the penetration rate, which is also could be considered the acceptance rate. So will seniors housing cash in on that value proposition of safety, security, health, wellness, engagement? Or will alternative housing properties, alternative options for seniors housing, will they start to become more popular? I think what's really important here is that the better the prospective resident understands and is communicated that the value proposition, the better and faster the recovery will be. A few things that'll considerably slow down the recovery. You know, if we want to consider the historical pace, certainly in the third quarter of 2021, we had historical pace of absorption. Will that continue is a question, or will it be more conservative as to what we've seen in the past? Also, will past performance be an indicator of future results? Big question. Headline risk. You know, we've had a lot of negative press over the course of the pandemic. Will that seep into the psyche of our consumer, or will consumer confidence also be taken a hit from all that negative press? Not only will there be potential issues in the confidence in the safety of our communities, but also in the confidence in our economy. So those are some things that could slow down the pace of recovery. Now, the second ingredient is uptake of units and lease up during the pandemic. And between the first quarter of 2020 and the third quarter of 2021, there were 30,000 units added to inventory. And if you take a look at those kind of those blue bars, if you can see them in the chart, those are representing quarterly inventory growth. And you know, if you kind of eyeball those and look at them, you can tell that the level hasn't deviated that much in the past few years in terms of inventory growth. There is some very good news, and I think you all are aware of it, that we've had an occupancy increase. In fact, occupancy increased by 1.4 percentage points in the third quarter to 80.1%, and that's up from 78.7%, which was our historic low that was reached in the first and second quarters of 2021. So not only did we see the highest increase in occupancy on record, but we also saw the highest increase in absorption on record. And you can see that by the chart. the very tall orange spike at the far right of the chart. We had record high absorption across the property types, basically, in the third quarter. And occupied units actually increased by a total of 12,318. The last time we had a record absorption was in the third quarter of 2019, and that increase was about 5,200 units. So I think it's easy to say that we've seen some pent-up demand in terms of absorption. We're looking at an absorption rate of 12,000 units in the third quarter versus a previous record of 5,200 units. Couple of things I want to point out with this chart. The occupancy rate fell further and faster during the pandemic than it did during our last national crisis, the great financial crisis of 2007 to 2010. During the pandemic, the occupancy rate fell by 8.7 percentage points. During the GFC, it fell by 4.4 percentage points. So there was a greater loss in 1 year during the pandemic than there was in 3 years of the GFC. And I think it's important also to note that there's differences in these crises. The GFC was largely a financial crisis that was brought on by the crash of the housing market. The pandemic obviously was a health-related crisis. But if we think about what we saw this morning with our speakers, that there could be some time where this turns into a financial crisis. We have record low employment that the country's struggling against. We have growing, what's the word I'm looking for? Inflation, thank you. Trying not to think of inflation. Appreciate that. So yeah, there's growing inflation as well. So again, we're talking about the consumer confidence, and we have to think about the economic fallout from the pandemic as well. So the third ingredient is new units coming online now and in the future. And the third quarter saw the fewest units under construction since 2015. Prior to the pandemic, some seniors housing markets had seen a lot of excess supply, which resulted in a lot of competition and resulted in occupancy rates being pressured downward. And the good news is that some of that oversupply that was occurring actually started to put the brakes on new construction. So this was probably pretty good news for some of those assisted living operators that had seen a lot of new construction and a lot of new competition come into their markets. I think it's important to note from a timing perspective here that typically it takes 12 to 18 months for a senior living property to go from breaking ground to accepting new residents. And what we're hearing from developers nowadays is that it could take even longer now due to some of the constraints that we've seen in labor, supply chain issues, materials costs. These are all things that are delaying construction. And that moderation in construction could actually be fortuitous for us in terms of reoccupancy. As it may release some of that pressure on reoccupancy as we fight our way to recovery. So timing. Most of you know, NIC does not generate a lot of projections at this time, but we have put together kind of a quick exercise to help you get an idea of your own as to when the recovery could occur. And this is based on the principles that I just laid out in the slides. So it gives you a good way to look at your own projections. It's going to look at the units that are put back in the marketplace, as well as those that were opened and those that are going to be coming online that are currently in development. So walking through the table, if you can see that, for seniors housing, we'll start there. There were 42,344 units placed back on the market from the second quarter of 2020 to the first quarter of 2021. And this is for the primary markets in seniors housing, which includes independent living and assisted living. There were also 30,773 units added to inventory during the pandemic. And there were currently 33,014 units under development. So if we consider that about 15,682 units were absorbed during the second and third quarters just recently, that leaves us with 90,450 units to be absorbed. So, you can, if these units are absorbed at the same pace, the historical pace that we saw in the third quarter, that very high, record high absorption rate, then it could take 1.8 years to reach recovery. If we wanted to be a little bit more conservative and take a little bit more conservative look at the last couple quarters, that's going to bring it down to about 7,841 units, and that could take 2.9 years to reach recovery. But if you want to be really conservative and take a look at the last 10 years, the pace of absorption, that could take 7.7 years. That historical pace could take 7.7 years to absorb and return to recovery.
I'm going to opt out of the conservative look.
Me too.
Yeah,
Sign
it's
up
a
for
long time.
1.8.
Yeah, the point that I wanted to make is that there's a really wide difference in the pace of occupancy recovery possibilities. And this is just one scenario that you could look at. You can take this back and you can look at this with your NIC map data. You can do this on your own. And it gives you some idea of maybe where you are in terms of the recovery with your portfolios and your properties. You'll need to do some adjustment of these assumptions, obviously. You may find that absorption is faster in your market, slower in your market. There may be more supply. So along with the demographics and a lot of the other things I talked about, these are things that you'll want to consider when you adjust these projections for yourself. But you can take this back with you. There are some additional drivers of recovery timing that could make things faster or slower. So the first one is, we need to decide whether or not, when we're looking at our scenarios, whether or not the industry is going to provide more access and choice through product segmentation, or will senior living remain unattainable for many in terms of affordability? Will senior living embrace supportive technologies to offset some of the staffing and labor shortages that we're dealing with? One of the pandemic's big challenges in terms of operator margins, actually two of the biggest challenges, are expenses in labor and expenses and insurance costs. These things are rising and they're putting a lot of pressure on operator margins. So will there be new rent concessions to support occupancy, or will there be rent growth to support all these expenses that are kind of piling up, especially after we've seen so much vacancy? And finally, will the industry adapt to changing consumer preferences? Will it give residents the lifestyle and safety that they're looking for? Will that value proposition be communicated effectively? Or will alternatives to seniors housing, such as naturally occurring retirement communities and home and community-based services, will they kind of pick up in popularity and become more the norm? These are some things that you need to consider when you do your own calculations about absorption and calculating the recovery. And at this point, I've introduced to you some of the nuts and bolts in terms of the NIC map data. And I'm going to turn it over to the panel now, and they're going to talk a little bit more in depth about what some of these drivers of demand are.
Thank you, Lana. It's very, very insightful. When we were planning this panel, which was several months ago initially, we knew we'd be talking about occupancy recovery. We thought a secondary topic might be some new COVID variant. Thankfully, we're not covering that today, but we are covering an emerging issue. Any guesses? Labor cost. So we added that to the agenda, and our panel is going to address that, and we're going to start with Nicole. And Nicole, the question is when you consider labor challenges, Is there an end in sight?
So I think that we're all like extremely aware how challenging it is across the country right now. And I would say that one of, I think, the hard things for us when we think about like how quickly is this going to improve is really just looking at the different reasons why people are not in the labor force today. And from all of the information we've been able to glean, it really feels like there's a lot of different reasons why folks have opted out of the labor force. And I think that makes it harder to kind of predict when different levers are going to be pulled to invite folks back in or push folks back in. So I think from our perspective overall, we are anticipating a continued challenged period for quite a while. And I think, whereas I think a lot of us had hope that as the extra federal unemployment benefits burned off, we would start to see, more folks returning into the labor markets. Like we really haven't seen that, I think, across the country, and that was disappointing. So, whether it's a question of people are able to live for a few more months and then start to flow back in, that's our hope. But we're not, in our underwriting, we're not comfortable assuming it's going to get better very quickly.
Okay, so you're not, it doesn't sound like you're underwriting a permanent impact necessarily either, are you?
I would say that overall, when we think about margin, which I think we're going to talk about a little later, I think that we are anticipating some challenge to margin long term and some kind of correction to a different level. And we can talk about how that changes based on whether it's Class A properties or Class B and whether it's different regions. I think if I take a step back just overall, so we invest in all different property types. And the labor issues for a lot of property types, it's great, right? If you think about multifamily, they're definitely the beneficiary of the wage growth that we're seeing, right? And then even when you think about hospitality, which is similar to senior housing, even there in some ways we've benefited because hotels are able to cut back on the in-room dining or do less housekeeping. It's much harder on the senior housing side to figure out how to scale back. So big picture, when we look across property types, I would say it is definitely like the labor shortage is the most acute and the most impactful for senior housing compared to other property types. And we are being somewhat, conservative in thinking how quickly that's going to change.
Okay, all right, thank you. Over to Chris. Chris, are the labor challenges impacting your ability to grow occupancy? And if so, in particular areas and to what magnitude?
Yeah, as we think about labor challenges, the areas that it's affected us the most on trying to grow occupancy has been our skilled nursing settings. It hasn't really impacted us that much in independent living, a couple misses here or there with some of our assisted living settings, but truly it's been more about the skilled setting. As we've had COVID outbreaks here or there, and we've decided to close down some of our wings as we started opening back up through the early part of the summer as the labor challenges really started to engulf all of us. We've kept a few of them closed just because we couldn't, one, there wasn't enough contract labor. They were charging way too much money to have the staffing there where it just wasn't really making money to have some of those admissions come in. But it's been unique. We've created a lot of different flex staffing options, as many of us have, and trying to do something a little bit different to make sure that we're able to provide the services and needs that the customer is still coming to the doorstep for.
And have you made some adjustments from a recruiting standpoint?
We did. When we think about that, I'm going to touch on this on a recruiting piece, but then I keep trying to remind our operators really stay focused on the retention, right? Love those who are close and working for us today so we don't lose them. But as we think about the tactics, they haven't changed as much, but it's really more about the intensity that we've seen from our executive directors being involved in day-to-day recruiting, going through LinkedIn, any other job website, using all the different apps that we can through Handshake, you name it, to try to fill the spaces. But it takes a hard focus from the executive directors and the department heads. I've even heard unique stories where they got creative down in Florida and they decided to have tailgate parties in the parking lot of a Walmart. When I first heard this story, I thought it was a little unique and I didn't want to judge. But then we heard the outcome. We actually got a few people putting in applications because they knew there might be some people there that would be interested in coming to work for this community. And a handful of others have done it on a monthly basis to see if they can do things. So they've shifted a little bit and they're trying to get as creative as possible on the recruiting front. But it's really about retention as well. Keeping who you have so we don't lose them. Making sure they really appreciate the culture that you have in your individual communities because we know people don't leave because of money all the time.
And are you seeing any common themes across your company, or are there certain communities that are in better position to to work through the labor issues?
You know, as we were talking about on a regional basis, we haven't seen too much difference on the regional basis. Sometimes we did with red states versus blue states because the red states took away some of the benefits. We did see uptick in applications, not significant. So that was a challenge. We thought it would start coming back to us by the fourth quarter. We believe and are hopeful that it'll be turning around as we come around to the new year, coming out of the election season. So we'll see what that comes out of it. But it's really about the intensity that the teams have put on and executing on recruiting and retention of their people.
Okay, thank you. I'm going to add some insights that I learned through my experience operating in the UK. When I started in 2017, operating a large national company in England, Scotland, and Wales, the agency cost was double digits in terms of percentage of overall payroll. So partly the reason for that was the Brexit noise had started. Some Europeans made an early exit from the UK in anticipation of Brexit. That caused a labor shortage. I literally had markets that had zero unemployment. So we had a challenge to face. There's a few things we did that actually did make an impact, and we were able to reduce that, cut the agency in half. And one of the ways we did it was to get our applicant tracking system in place. You know, typically, senior housing likes to handle recruiting from management and up, and then they ask communities to manage the line staff recruiting. We centralize line staff recruiting. When you're working across 25,000 employees, you need technology to assist with that. So we had an applicant tracking system. We had a small team of recruiters we added to work through those applications to make sure that they're being followed up on, the interviews are being scheduled, applications are being completed, and had a real professionalized approach, which would be similar to how we manage our sales lead bank. Very, very intense focus, so we can actually get people hired more effectively than the decentralized way that was done before. That definitely worked, and it was a big culture change and a huge help to the local communities. The other thing is, I mentioned, a big group of employees. We had 10% of that workforce that literally had no schedule. And if you think about the gig economy and people that really want to work a shift here and there and work for different companies, and in the US now you can access healthcare very cheaply through the government. In the UK, it was free, through NHS, and so they don't need a full-time job with benefits anymore. You might have someone that's working in a senior housing community, works a few shifts, drives an Uber, does some babysitting, accesses their health care through the government, and they have what they need in life. So we need to adjust to them. And it's typical in senior housing to recruit for specific shifts, specific roles, full-time, part-time. And we just threw that whole thing out and went with a large, what we call bank staff. It's a per diem group of employees. They told us when they wanted to work. And we'd contact them, we would tell them the shifts that were available, and then we'd tell them how paying for those shifts, and they'd decide if they want to come or not. And that gave us a large part of our workforce that was flexible, and certainly playing straight into what the market was demanding from an employer standpoint. And that is definitely what we're seeing here in the U.S. and in our sector and across other sectors. One thing I will say, just following up on the comments, is I do think that hospitality has advantages because they're able to cut back on certain services. But senior housing has advantages too, because we have a core group of employees that are attracted to this business for the altruistic nature of the business. And that employment pool stayed in place during the pandemic. Yeah. We did not cut them back. They stayed in place, helped the sector through, and then now we have certain markets, I'm sure, that are facing labor challenges, but we didn't have to go access as many people fresh off the street as hospitality did. So I think there's playing into the rewarding experience that people get working within senior housing is always worked for us, and it's always going to be a key part of being successful employers in the space. Okay, I am going to hand it over to Bree for the next topic.
Yes.
Well, before you go there,
Yes.
I will also say, though, as we think about it in this sector, all of us need to make sure we're doing something unique that makes it an attractive place for the employee, because I think that's been, how do you make the sexy business to go work in? Fun story I always like to share. I had two ladies that used to be our babysitters in our neighborhood. They went on to nursing school. And I told them, I said, listen, when you get out of school, I can get you a job in about any state you want. You just tell me where you want to go. And as they're finishing up their senior season, they were telling me they're going to the hospitals, because that's where the action is. And I thought, no, how do we lose this? Because you can care for seniors for 2 to 10 years, and that's a meaningful, impactful thing to do. And that's what we have to do as an industry as we keep trying to turn this labor uniqueness around.
Yeah, we had a fun experience we have a high-rise in downtown Seattle, and the restaurants all shut down in Seattle. A lot of them are still closed, and we were a beneficiary of that on the food and beverage side. Our bartender worked at one of the major steakhouses in Seattle. And I had lunch there recently, and I was talking to her, and she's like, oh no, I'm never, ever, ever going back. She said, because as a bartender at a restaurant, I saw a lot of people having bad days. And every once in a while in senior living, I see people having bad days too. But you know what I get to do now? I can fix it with an extra scoop of ice cream most of the time. And so she's like, I see the same people every day. They love me, I love them. That is something you do not have. And so we have gained this pool of people who, one, love that they're home by 11, two, love that they now build a relationship, and they would have never, ever considered us before. So there are some wins. Not to diminish the hard parts, but we've had some real wins too that are pretty great.
That's great.
Labor, a little bit of a hard topic. The one we thought we were going to be able to focus on besides COVID was market factors. When we hear Lana talk about recovery, I'm sure most of you are in the same situation. We have some communities that are back or above occupancy from where they started the pandemic. And we have some that have been far more challenging. So Chris, I'm going to start with you. I would love to hear a little bit about your experience. Are there markets, product types? What are the factors, any commonalities of where you've seen recovery and where you've seen challenges?
Yeah, we've seen nice recovery across our entire portfolio.
Congratulations.
Well, thanks. But, are we where we want to be? No.
Yeah.
As Lana pointed out, we lost a lot of occupancy as an industry. So did LCS, and not near as much as maybe some of our partners have. But we've been able to see recovery. And as we talk about the pent-up demand, I think naturally everyone goes to that's probably for assisted living and memory care. But as our occupancy gains started running in the spring, it really was driven from independent living, right? Our life plan business is well ahead of 2019 sales perspectives, and that was surprising for us. We were hoping for it to come up, but it's about 25% ahead of our plan. Same thing on our rental business. Our leading indicators are above 2019 levels, just like many of us in the room. And as we look at it and we analyze the details, we think about that customer who is maybe looking for independent living down the road. They didn't want to go through another year like 2020 and the isolation they had at their own home. So they're coming to our doorstep and trying to make that decision to move into one of our communities. So it's been a great opportunity. The key piece behind it, though, for us to have this success is really the execution by the sales teams and by those executive directors in and day out. We were here, I came in on Sunday, and I have a building down in League City, Delania South Shore, and they had an amazing run through this pandemic. They opened up in 2018. We had to make a change in leadership. We started seeing things really hit their cycle in 2019, and then we know what happened in 2020. Well, Heidi Haight, our executive director there, I was able to celebrate with her because they've had 93 move-ins through October from the start of the year. It's about her focus and her salesperson's focus on the customer's still coming, they still have needs, focus on the value we have, stay away from the ugly stories that somebody may have read in the newspaper, and you're going to deliver. It's really about execution.
We've seen the same, and we've seen it both in terms of recovery and in terms of minimizing labor challenges. Where we have really great leaders and department heads, everything else has fallen into place much more seamlessly. Yeah. Nicole, for you, what do you feel like the primary drivers of recovery are? We heard, some of Lana's, but what is that? Both from a macro environment standpoint, from a market PMA level, what's the trick?
Yeah, no, so I would say, overall, I think we are quite actually optimistic about the sector right now and do feel like it's the right time to be investing and buying. And I would not have said that for a long period of time. For a long period of time, we really developed in very high barrier to entry locations, and we're really careful because of a lot of the supply we were concerned about. But now we are really focused on acquiring, and I think when we look at it, what we're positive about is, we do feel like we've bottomed out, right, from a demand side perspective. The supply is definitely coming down, and I think Lana can talk a little bit more to, not just the slide we saw, but also what do the construction starts look like, right, more of like a forward indicator as well. But I think that's a positive statement. And then also when we compare it to the GFC, we have these record high home prices across the country right now, right? And so that decision, whether it's, for choice or for need, is a lot easier to pull the trigger on today because you do have a supportive home environment. So I think that, overall, we feel like between the demographics, the bottoming out from a COVID perspective, the, more decreasing, more regulated supply, and the positive kind of home value background, that we feel better about it from a macro perspective than we have in a long time.
That home value is real. And that's actually some coaching we have done with our sales teams of really helping them understand the perspective of our prospective resident, as opposed to what you see on the news or what you maybe experience in your personal life. The stock market, the home values, never better for most of our consumers. Most of them are homeowners. And so really reframing that discussion helps limit the concessions.
Yes.
Okay, I'm gonna ask this of everyone up here. Favorite markets? What are your favorite markets? We'll start with you, Nicole, right now.
So I would say we're generally fairly agnostic. Like, we're happy to invest anywhere. It's really a question of what price are we paying, right? Because we're very focused on basis at the end of the day. But that said, I would say obviously we have favored in the past markets that are harder to build in, since supply has been one of the big challenges for the industry. So I would say that's probably continuing to be the case on the margin. We have seen less new supply on the West Coast and New England, where it's harder generally to develop. So we like those. And I would say, also going back to the labor issue as well, like we have seen a bit of a regional disparity. And I think what's interesting is it's kind of like the opposite of what we all would have expected, where historically, the states that are more business friendly, where they've had lower wages, we're actually seeing more percentage increase required there probably to bring people back into the labor force than you are from a percentage increase basis in places that have had a lot of minimum wage required increases, and have higher level wages already. So I think that's something that we're definitely baking into our underwriting, is looking from a regional perspective. Some of the red states may actually have bigger percentage hits going forward from a labor perspective than some of the other markets.
Interesting. Justin, any favorite market?
Definitely, yeah. However, it's outside of the U.S., it's Canada. Canada, as a sector, has been at least 90% occupied over the past 10 years. The supply-demand fundamentals there are fantastic. The aging demand is really twice as strong as the U.S. over the next few years. So we have a big exposure there. We're acquiring there, we're developing there. Canada is great. I'd say in terms of the U.S., we tend to get very much more local market focused. We want to be sure that we have, first of all, a market that supports growth. Secondly, that we have a community that's positioned to be successful within that market, and then the right manager, managing that community moving forward and really positioning it for value creation and growth. And we do spend. I wouldn't pick a favorite U.S. market. I'd just say the approach is very consistent. It's very local, very disciplined, and very detailed.
Chris, any favorite markets or favorite features of a market?
The one that Nicole highlighted, high barriers to entry, are something we're looking at. We launched our Delaney portfolio back in 2015 and picked a couple sites in Texas. Off to a great start. Everybody else built right around us, so it was difficult. So that's kind of the feature that we're trying to track as well.
Yep. Lana, I know you don't. I know you don't pick favorites, and I know you don't do a lot of projections. But anything you saw in the data, limited construction starts anywhere? Any hot tips?
I think the hottest tip I could give is just to look for those markets that didn't have a lot of problems with vacancy during the pandemic. Maybe some of those markets that were not hit quite as hard. Maybe some of those product types that were not hit quite as hard. With COVID mortality. Also taking a look at those markets that have seen less inventory come in. I think, if you look at the primary markets versus the secondary markets have seen a little bit less inventory growth, and there may be some more opportunity in those smaller markets, potentially. You have to do your homework and you have to look. And also some of those markets that have seen less construction starts. Construction starts are down, certainly, since the pandemic began. There's been a little bit of increase in construction lending, I understand, but it hasn't gone crazy yet. So what we have right now is a situation where there's a bit of a buffer because we haven't had so much construction and new construction into the pipeline that it should help us with regaining reoccupancy, hopefully.
We talk a lot about census growth, and I think we're all delighted when we see the growth numbers and the percentage upticks. But there's another layer, certainly as an investor, that we have to consider in that, which is cash flow or an NOI recovery, which feels like there are some different factors at play, certainly as we talk about labor. This is the hot topic. I don't know how many times you've had this discussion since you've been here, but I'm gonna start with you, Chris, which is give us a little insight into rental increases for the next year. As an operator, I keep getting asked this question, what are you seeing? What can you do?
Yeah.
So tell us, what are you seeing? What can you do?
I have never talked about rate increases more in my entire life until 2021 with different partners and different roundtables I've sat on. Generally I'll share, I've not heard anybody say anything below 5%. We've got buildings that are going to be going up closer to 9% based on just the cost of our delivery of services, right? I think in senior housing, we've always been a bit reserved and not wanting to push too much of our costs onto the customer. Every other industry will do it, right? I believe in California, I read a report that McDonald's went out to a starting pay at $22 an hour, right? But the Big Mac also went up a few cents, right? So they're going to pass that on to the customer. As we spent time with our executive directors working through the rate increases, it's really making sure that we're very open, sharing as much as we can with our residents and their families, helping them understand truly we've made adjustments to our labor fees and wages 2 to 3 times already this year, and we expect some bigger hits in the next year. So this is why we're going to have this type of rent increase. We did get a little bit of wind behind our sails, I believe, as our customer is going to see a nice Social Security uptick of about 5.9%. So we shouldn't be afraid of making sure they understand what our costs are to deliver the services that they enjoy. And we're going to be in those bigger ranges than we've typically have ever seen.
Yeah, we're hearing the same thing.
Yeah.
Absolutely. Along those lines, concessions were a big part. I think we certainly heard it from our sales teams, from our general managers, the beginning part of this year, that concessions were a huge part of, or at least a contributor to the recovery. Are you seeing a need for concessions? Have you gone away from that? Are you still seeing that in certain markets where there's this broad use of concessions?
Yeah, market to market, you're going to have individual operators that are doing unique concessions that's causing a lot of trouble. We've tried to be very disciplined, stick to anything that's going to burn off in the first 90 days. The rate locks we hear about just paralyze a business over time. We had a unique competition set up in a market, and the building filled up a little quicker than ours, and we were trying to understand what were they doing. Well, that building has now gone to market. The NOI was very uninspiring because the rates that they're charging the customer weren't very high. So concessions that are on the bigger side are just going to burn you at the end of the day. So it's been challenging, and it's been, again, going back to the values to why somebody is making that decision. The story I shared about Delaney South Shore, we didn't do any major concessions. We were actually charging a rate pretty significantly higher than our main competitor, and we've filled up, and they're still stuck at 65% occupancy. So the customer recognizes when I'm trying to discount too much, so is the service not going to be there? So we always got to think about that as we're trying to set up the next quarter's worth of concessions that we want to leverage to fill our occupancy.
You touched on this a little bit earlier, Nicole, but talk about what you're underwriting and that future look of impact to margins. I think we can all agree we can't sort of unring the bell of new starting wages and what we're hiring people at. That is what it is, and it's higher than it used to be. So what does that look like? What are those factors that you're considering, and what does that look like next year, 2 years, 5 years?
Mm-hmm. Yeah, so I think there's a real disparity between product types, right? For one, so when we think about the concessions, right, that were offered, it's going to make a big difference if you have turnover every 2 years or turnover every 7 years, right? So for something like independent living, if you can keep passing through these higher, mid to high single-digit increases every year, you have a stickier tenant base there, and so that's really going to help you. I think on the assisted living memory care side, where typically we see more of that 40 to 50% turnover a year, there it's great to be able to pass through the mid to high single-digit, but you're also, what's going to be as important as how much you're increasing the existing folks is how quickly can you burn off the concessions on the market rate, right? Because really what we have right now is generally buildings where the average in place rates is better than what the market rates are still. So I think that's a big question mark. How quickly does the market rate recover? Obviously based on how much supply there is in that specific market, but then also what does that turnover look like for the existing rent roll? And I think that differs just based on acuity level of the building generally. And then on the labor side, again, I think it's kind of like a big range, right? Because obviously for the higher acuity, you have more labor needs. So I would say, again, for us, there's kind of like two different ways we're looking at it. One is Class A versus Class B, right? Like the Class A communities, more affluent renter base, you can probably be passing through more consistently high year-over-year increases. So we're then a little bit more cautious on the Class B middle market. Can you really be increasing as high every year there on the revenue side? So that's one concern. And then as well on the labor side, again, looking at on the acuity side and also regionally, how bad is it in one region versus another? Because we are seeing more expense pressures in kind of like the red states, I guess, than we are in the blue states right now, not just on the labor side, but also on the property insurance side when you think about like climate change and how litigious a state is as well. So I think there's a lot of different factors, but I would say overall on the Class B, we're probably a little bit more conservative in terms of taking more of a permanent slight discount to the stabilized margin that we historically had seen than we are with Class A. And similarly in certain regions, we think it's going to be more challenging than others.
Justin, before I turn it over to you for the next topic, question. Tell us a little bit about your view regarding the opportunity for net absorption as we look at the sector over the next 3 to 5 years. So not tomorrow, but the next future.
Sure. So when I made my investment thesis on returning to the U.S. from the U.K. to join Ventas and this exciting opportunity was in 2020. I started in March of 2020.
Excellent
there would
timing.
be, construction starts were lower, construction's percentage of inventory was lower, and aging demographic was going up. So it seemed like a great time to re-enter the U.S. market, and then we had a pandemic. So that's put a dent in things. But if you look at it now, you saw some data earlier. One thing that really wasn't mentioned is that for a period of time, as we're recovering, there's opportunity for structurally lower move-outs as well. We're moving people out at the same rate off of a lower occupancy, and so there's this built-in kind of net opportunity that we haven't had in the past. Kind of a double-edged sword because we haven't had occupancy this low before. So that's happening, and you're seeing it happening across the sector. You're seeing it happening in portfolios such as the Ventas portfolio, where we've had really strong absorption. And if you look ahead and consider all the commentary around new construction and how low that's going to be and how strong the aging demographic is, it certainly seems like in the near term, call it the next few years, there's a window of opportunity for net absorption of which we've never seen before in this sector. Like I say, people, I've been in the sector for 25 plus years and the demographics have finally arrived. So that looks really good. And then if you just go out to the 5-year period, and you look at the aging demographic, it starts to accelerate even more. And there will definitely be new supply that comes to the space. The capital will see through the fundamentals. They'll tackle all the challenges that they're facing, in terms of cost of construction, because they're going to want to chase that demographic. So it will come, and there's a need for it. But when it comes, the demand picks up even more. So, we like the opportunity over the next 3 to 5 years to really participate in the senior housing recovery. We're also mindful of the fact that it's not going to be a straight line up. It'll move around a bit, I'm sure, on the way up in a positive direction, but it will also, we'll encounter challenges along the way, but the underlying fundamentals are really strong, and the timing is really kind of the big question. And I think Lana did a good job of outlining, the goalpost and the very conservative point of view, and then aggressive point of view. And then within that, we certainly believe, to my point earlier, if you're in the right market with the right communities and the right manager creating value for you, we're going to have winners and losers as well. We'll certainly have market leaders that recover much faster. You said you've already seen it in your portfolio. You're seeing widespread recovery already within your company, and I'm sure you have plenty that aren't recovering yet. And so that's going to be something to keep an eye on as well. And that's where we all make our living, is to try to make sure we're positioned in the right markets, well positioned in the right markets.
Great.
So it's my turn again. Okay, so we are going to do some wrap up. This is the growth and the crystal ball. And kind of softball, if you ask me, but we'll go with these. So we'll say, when you consider all the factors, uncertainty, and opportunity right now, this is for Chris, do you see most of your growth as organic growth over the next 2 to 5 years, or most growth through acquisition, development, and or new operations?
Yeah, it's going to be, for LCS, it's going to be a blend of both. We opened up about 15 communities over the last 3 years. They'll continue to fill up on the organic side. We're going to be very active in the acquisition market. We're trying to take a look at a lot of things that are coming to the table. We're also trying to understand people's valuation on the price per door, which has been a little unique, but we're going to work through that. And then most recently, we've more than doubled up on our national sales team to get out there and work those lines, because as Lana has highlighted, the demographics are all behind our sales, and we should have a lot of good opportunities as an industry as we keep going forward.
Great, thank you. And Nicole, what we want from you is we want to know exactly when we should expect NOI to be fully recovered. I'm kidding. So you knew that was coming, didn't you? So I was actually going to ask you about, thinking about demographics and the fact that it's really the 5 years after then next 5 years where the demographic wave collides with senior living. Are you exiting during the upturn or doubling down? And so that's that period of time I was describing earlier where things really pick up again.
Yeah. So I think a lot of that depends on everyone in the audience and how much new supply comes on. Right? Because if the supply stays in check, I do think there's really an awesome opportunity for the sector. And if the supply just, surges again, I think it's going to be more challenging. But I would say overall, when we think about, anything we're buying today, if we're exiting in 3 or 5 years, how do we feel about cap rates then, et cetera? Obviously there's inflation concerns now that would make you think that potentially cap rates could go up. But when we look out at the demographics and how amazing it'll be in the second half of this decade, that helps us feel like there could be a little bit more of a lid on the cap rate, and that it should be really supportive for the sector.
Right.
So whether we're selling, stuff we buy today into that, benefit and realizing the benefit there, or, doubling down at that time, I think a lot of it is just going to depend on the supply levels.
And do you prefer longer holds, or, what's your typical, investment thesis in terms of hold time?
So generally speaking, in the senior housing space, we've mostly been opportunistic investors. And so whether that's developing or, buying value add kind of turnaround situations, we're really looking to exit in 3 to 5 years and make more of an opportunistic return. I think there's a lot of operational risks, so we want to make sure that we can get in and kind of fix things and then hopefully exit in an attractive.
Crystallize your returns. Sounds good. Thank you. Okay, back to you, Bree.
Yeah, we've got a few minutes left. I know probably some of you are starting to look at 1:30 meetings, but we do have some good questions that have come in. The first one is for you, Justin.
Okay.
How does just-in-time staffing go over with residents? Does satisfaction or care suffer from not having that consistent person to either deliver care, housekeeping, things like that?
Right, yeah, so that you certainly, if you've been in the space for a long time, you've been operating, you know that one of the great strengths, and it was mentioned earlier, is the relationship that's built with staff and the continuity of care. Now, one thing that I can tell you from experience, and I know there's operators that are experiencing this today, is that the kind of the lowest quality and highest cost care is external agency. So you're paying 2 and 3 plus times for the lack of continuity, but also someone that's not even really one of your employees. And so the method I was referring to earlier is where you hire a group of staff that is fully trained by your company. And so where they fully trained, they understand the culture. They had exposure within a community before they ever worked for us. And so, no, you're not going to have as much continuity or a relationship, but what you are going to have is someone that's your person, that's committed to your values as a company, that's been trained and can deliver high quality care. And I think that's the differentiator. Plus, you're going to pay much less for it.
I love it.
Great.
Next question. How do you typically, and Chris, we'll start with you on this one, how do you typically implement your rental increases, annually or on anniversary dates?
Ours are typically on an annual basis that we move through, and it seems a little bit smoother than that for us versus trying to manage it throughout the entire portfolio, different timelines throughout the year. But we do have some existing buildings that have been on an anniversary basis.
We were historically more anniversary date focused, and the pandemic provided a unique opportunity to easily shift, because in a lot of cases we did not pass on rental increases in 2020. And so everybody got their notice at the same time, which now means their anniversary date of an increase is all the same. I think there are pros and cons to both. If you're doing a big one, you either rip the Band-Aid off or you have little chunks of it.
Don't be afraid of it.
Rip the Band-Aid off. That's, yeah, absolutely. All right, another question came in about construction, and I don't know if this panel will have thoughts on this. What is the current time frame for new construction of assisted livings for occupancy stabilization to occur post-opening? It depends on the size of the building, for sure. If 80 units versus 200 units is probably different.
Yeah, in our 200-unit buildings, we've been getting closer to 3 years, and we've also been very cautious, recognizing that coming out of the pandemic, that could be just a little bit longer. We have been, I know there's been some conversation around underwriting. We have been putting in more dollars on our underwriting on the labor side than we ever saw before, just because we're not sure what it's going to look like long term.
Yep, absolutely. Any other insight, stabilization rates that you sort of say, yeah, that's reasonable, or not, no way? Any?
I would just say ask us in 3 years.
Fair
and I can tell you
enough.
exactly what happened.
Right? All right, so the recovery framework includes 100% of the units, this is probably for you, Lana, 100% of the units currently under construction, 33,000, as part of the recovery. But based on history, construction won't drop to zero. Could you comment on the historical ranges for the construction pipeline?
I think that question is a bit broad. I mean, we've had certain markets that have seen a lot more construction than others in recent quarters, certainly. I'm not sure I understand the question fully.
Yeah, I think it just, where we're at now is low. It's not going to stay low. It's not going to drop to zero. Is it reasonable, I think, maybe to assume that it will go back up to standard levels, and how much higher are those standard levels?
Yeah, that's hard to say in the short term.
Yeah.
I'd focus on starts. I would go there right now at first, because starts have just cratered. And once you get started again, you're 2 to 3 to 4 years out before you start seeing new supply coming on. And so there's clearly, the table is set for less new construction. That's for sure. And I'd be less concerned about it in the next few years. I'd be more concerned about it in 4 to 5 years, but like I said earlier, the aging demand starts to pick up again then as well. So the timing's relatively good from that perspective.
Yeah, and we do have some challenges with regard to new construction right now. I mean, there hasn't been a lot of new construction lending. That's probably poised to change soon. But, we've also got the problems with the supply chain and the costs. I mean, the costs are astronomical with regard to development. So I think in the short term, construction's going to be lower. Who knows if it's going to get back up to the frenzy rate that it was back in like 2017, 2018. But, we'll have to wait and see how that goes.
Yeah. Okay, last question. For the panel, most portfolios seem to have pretty good recovery. Is this mostly an IL, AL, or are there any trends by acuity type that anybody can speak to?
Yeah, for us, it's been a blend of all three, independent living, assisted living, memory care, even on our life plan business. The biggest one that'll remain to turn around for us and in the sector is a skilled nursing piece.
Any insights from what you've seen, Justin?
Yeah, so we have, independent living, assisted living, memory care across the country, and we've been trying to look for a trend, and quite frankly, it's a widespread, broad recovery that we've been seeing. Assisted living is a little faster, I'd say, in memory care, but it's been really strong in independent living as well.
Yeah, we've seen the same. Independent assisted living, memory care. It's been more market or community specific necessarily than a trend by care type across the board, at least from what we've seen. All right. Well, with that, we're going to let you get back to your afternoons. Thank you so much for spending the last hour with us, and good luck as you recover in your own communities.